You can buy an ETF for semiconductors, for banks, airlines, home builders, energy companies. You can even buy an exchange traded fund for uranium miners. Yeah, that's a thing. But if you want to buy a dedicated railroad ETF, you are out of luck. Isn't that a little odd? We're going to talk about that today. We're going to go into why one doesn't exist, why one probably could exist, and why Wall Street has never bothered to create one. Welcome back to Railroad Economics. My name is Mark Magana. I am not a railroad executive, engineer, conductor, or your financial advisor. Let's be clear about that. I am just a commercial real estate investor and a securities investor who's been doing this for about 30 years. And I also really like trains and exploring how the railroads make money. Today, I am going to answer the question I've wondered about for years. I actually did a fair amount of research for this video. Why the heck isn't there a railroad ETF? Well, the first problem is surprisingly simple, and we touched on it in the last video. There aren't very many publicly traded railroads left. Today, the major publicly traded North American railroads are Union Pacific, CSX, Norfolk Southern, Canadian National, and Canadian Pacific Kansas City. That's the list. There's no other publicly traded railroads, not even class twos or short lines. They're all privately owned. Kansas City Southern was recently acquired by Canadian Pacific. BNSF, you're probably wondering why I didn't mention BNSF. Well, Warren Buffett gobbled it up about 16, 17 years ago for Berkshire Hathaway. Most regional and short line railroads, all of them, I think, are privately held. Unlike industries such as technology, banking, healthcare, where investors can choose across dozens, sometimes hundreds of companies, railroads only give ETF providers a handful of stocks to work with. That's the first challenge. The second challenge is that a railroad ETF would probably look almost identical to the railroad index we discussed in a previous video. And if you missed that, just to catch you up very briefly, there is a railroad index that tracks the railroads. There's only five stocks in it, which is really bizarre. And I'd highly recommend you go back and watch that video before delving too far into this. But the railroad index is interesting, and it does exist. If a investment company, if Charles Schwab or somebody decided that they were going to launch a railroad ETF tomorrow, the index would the ETF would simply look exactly the same as the index. That's not a problem per se. We see the S&P 500 index, and lots of companies launch total market and ETFs and stuff like that, and they look virtually identical to the S&P 500. But with railroads, we're only talking about five stocks, and if the Union Pacific Norfolk Southern merger goes through, we're only going to be talking about four stocks. So Wall Street, in general, likes to create a product that offers something kind of unique, and when we're talking about a basket of five stocks, that just doesn't get anyone excited. A railroad ETF would largely just be a repackaged version of a portfolio that you, me, or anyone else could easily build themselves in a few minutes. But that's not even the biggest reason. What it really comes down to is probably just money. Creating an ETF isn't free. I actually looked into this. Not that I was going to go out and start my own railroad ETF, but I was very curious what goes into creating an ETF, and that's not a video for this channel, but I delved into that a little bit, and of course, there's legal costs, compliance costs, administrative costs. You have to pay to get a ticker symbol and be listed on one of the exchanges. That there's fees for that. There's marketing expenses. That's a big one. And there's the ongoing management fee that we've all seen and stuff like that. The little small percentage you pay to run the ETF. And launching a fund like that requires a lot of capital. You can't be a guy with a couple or a few hundred grand that is like, hey, I'm going to start a railroad ETF. It's just you need millions and millions of dollars to even have a shot at making a go of it, and a lot of that goes into marketing. So, in other words, the Charles Schwabs of the world, they would need investors willing to put significant amounts of money into the fund, and they don't think that a lot of investors are going to do that since there's only 5 stocks and they can easily just buy those on their own. And that's just where the railroads become a difficult sell. Even though the railroads are incredibly important to the economy, the sector itself is so small compared to technology, healthcare, financial services, and consumer products. An ETF company might look at the railroad industry and conclude there simply aren't enough investors interested in a railroad only fund to make the economics work. That's been my conclusion on that. There's even one more issue on top of that. Many investors already own a lot of the railroad stocks and maybe don't even realize it. If you own an S&P 500 fund, you have exposure to the railroads. If you own Berkshire Hathaway, you have exposure to BNSF. If you own industrial sector funds or transportation funds, you're getting exposure to railroads there too, most likely. From Wall Street's perspective, investors already have ways to participate in the railroad industry without needing a dedicated railroad ETF. Now, we went over some of the challenges, but if somebody really wanted to, maybe not you or me, but if Charles Schwab or whoever wanted to launch a railroad ETF, could they? Absolutely. There's nothing stopping an asset manager from creating a railroad ETF tomorrow. In fact, I'd probably buy shares in that, to be honest. The challenge is going to be attracting other investors or enough investors or big enough investors to make that profitable. And that's kind of what makes this topic interesting to me. One thing that gets overlooked is that, I double and triple check this, but one thing that gets overlooked is what strong performers railroad stocks have historically been. That may surprise some of you, but we'll touch on this a little bit. And I'm kind of teasing the next video, so shame on me. But in many periods, railroad investments have actually outperformed the broader stock market, especially over longer stretches of time. Now, that topic is definitely its own video, and that's probably going to be the next one I do for tomorrow. It's very interesting if you compare the railroads versus the S&P 500 over the last 50 years or even over the last 20 years. The results are going to surprise you. And I'll just leave that there for now until tomorrow's video. Maybe the question is whether Wall Street has been overlooking the opportunity, in my opinion. Um, because there are not many publicly traded railroads left. I get that the industry's heavily consolidated. Investors already have railroad exposure and broader funds. I get all those things, but on tomorrow's video, when we get into railroad performance versus the S&P, you might find yourself wondering, well, why isn't there just a railroad ETF that would make it so easy just to get exposure to all 5 stocks, and I don't have to pay close attention and reinvest my dividends and rebalance the thing. Maybe a very low cost railroad ETF is worth our time. And we'll touch on that next time. But if somebody ever decides to create one, there's a pretty good chance I will happily be one of the first buyers. Thank you for watching today's episode of Railroad Economics. My name is Mark Magana, and I appreciate you spending a few minutes with me today.